Now, in the previous session, we had completed non-current assets broadly. Today, we will be taking up financial instruments. So now, today, we will start with the next very important and a complex topic, which is financial instruments. Financial instruments is covered by majorly by IFRS 9. We do have IS 32 and IFRS 7 for presentation, disclosure, and other purposes. But largely accounting part is covered by IFRS 9, right? And when we talk about financial instrument, we are talking about two aspects, or rather three aspects. One is a financial asset. Then we have financial liability, and then the residual portion, which is called as the equity. So this equity is assets minus liabilities. The residual portion, whatever is left over in the entity, is called equity. Now, a financial instrument will be a financial asset for one entity, let us say a company A, and financial liability or equity for another entity. So when I say financial asset, first thing is it has to be an asset. Now when I say financial asset, okay, financial asset could be, let us say, trade receivable. Now if you have trade receivable for one company, you have trade payable for another company. So financial instrument is financial asset for one company and a financial liability or equity for another entity. So you have trade receivable, you have trade payable, or you have, let us say, investment in shares. So one company has invested in shares of another company, then for the other company, that portion would come under equity. So a financial instrument is financial asset for one company and financial liability or equity for another entity, right? Now, when we talk about financial assets, it is cash, or there is a right to receive cash or another financial asset, and this includes investment in equity, and this also includes favorable derivatives. Okay. Beyond this, no need to go into too much of depth of the definition. We have had a detailed understanding in the class. So when we say financial asset, it is cash or cash equivalents, right to receive cash. For example, trade receivable. Investment in equity, you have invested in equity of another company, so that is also financial asset. If there are favorable derivatives, that is also your financial asset. Something which is favorable, that you can classify as financial asset. And please remember, all of these has to come from contract. If it doesn't arise from contract, for example, there is income tax refund. If there is an income tax refund possible, then in that case, it is not a financial asset, because income tax refund does not arise out of a contract. So there has to be a contract, and these key elements or these broader aspects are what is covered under financial asset. So then what is financial liability? When you say financial liability, here we said right to receive. When there is a financial liability, then you have obligation to pay. So a trade payable, loan, all of these are your financial liabilities. Then you have unfavorable derivatives. These are also your financial liabilities broadly. Okay. Now, Examples of financial assets, it could be cash, trade receivable, investment in bonds, investment in equity, and all of that. Examples of financial liabilities, trade payables, loan taken, derivative transaction losses, and all of that. All of those are financial liabilities. Now, what we need to be very, comfortable with the given chapter is accounting for financial assets and broadly the accounting for financial liabilities. Please remember, when I say financial asset means we have a right to receive either cash or any other asset, or there is a favorable transaction. Now, when we talk about accounting for financial assets, there is initial recognition, then there is subsequent measurement. Initial recognition and subsequent measurement. Now, when we talk about initial recognition is at fair value minus transaction cost. Initial recognition, fair value minus transaction cost. So, for example, if I make investment in bond at 100 and so it will be plus transaction cost, my bad. Cost of bond, let us say 100, brokerage, let us say 5. So I will account for the transaction at 105. So always remember, financial asset will be initially recognized at fair value plus the transaction cost or adjusted for the transaction cost. But there is an exception. What is the exception? If financial asset is measured at fair value through P&L, then you will account for it at cost only. You will not account for the transaction, the transaction cost. So where will you take the transaction cost? Transaction cost will be taken to P&L. So if it is FVTPL, you will account for at cost only. Transaction charges are taken to P&L. Okay. Now, when it comes to subsequent measurement, there are 3 ways to do it. One is called the amortized cost method. Second one is fair value through other comprehensive income, and the third one is fair value through P&L. So one is amortized cost method, fair value through other comprehensive income, fair value through P&L. Okay. Now, when we talk about amortized cost method, here we will recognize interest income using effective rate of interest. So they will give you the effective rate of interest. They will give you the effective rate of interest. What you will need to do is you have to see what is the opening balance. For example, in this case, our opening balance is 105. Then on this, you will add interest at effective rate. For example, the effective rate of interest in this case is 6%. Okay. So 105 multiplied by 6% gives me 6.3. Always remember, interest income will be recognized using the effective rate only. It will always be recognized using the effective rate only. This 6.3. Now, interest received. Let us say this pays me 5% or 6%. No, not 6%, 5%. 5% rate of interest. So if that pays me 5% rate of interest, I will get 5 as interest, and the closing balance would be 105 plus 6.3, 111.3 minus 5, you will get 106.3. So like this, you will have to prepare the schedule under the amortized cost method. Each period, this 6.3 or whatever the number comes, that will be recognized in the P&L, and interest received will be reduced from the liability. Sir, how do we calculate this effective rate? This effective rate is nothing but you like your IRR. What is the amount you paid today? What is the amount you will get over the life of the bond? And what will be the closing balance? Considering all of these, your effective rate of interest is nothing but the IRR. So, if you are using the amortized cost method, you will have to prepare this amortization table. Can be a 2-mark question in the examination. Pretty simple and straightforward. Okay. Effective rate will be given to you in the question. You just need to know what is the initial cost or what is the initial recognition amount, interest at effective rate, interest received at coupon, and closing balance. Okay. So that is the subsequent measurement, using the amortized cost method. Now, this is used in case of debt instruments. Okay, you cannot use amortized cost method for equity. You will have to use amortized cost method using the debt instrument, where cash flows are only your principal and interest. So if cash flows are only your principal and interest, then in that case, you can follow amortized cost method. But if the intention is to make gain or loss by buying and selling bonds, then amortized cost method cannot be used. Okay. So if cash flows is principal and interest and no intention to sell, then in this case, you can use amortized cost method. Okay. That is the first method. Then, the second method is fair value through other comprehensive income method. Now, this is used again. You can use it for debt, where you have principal plus interest as cash flow plus gain or loss. There is an intention to sell the debt instrument to make some gain or loss. Then you can use fair value through other comprehensive income. Also, there is an option to designate equity investments as fair value through other comprehensive income if the entity wants. If the thing is chosen, then it is irreversible and it has to be done once for all. Okay. Then the third one is fair value through P&L. This is the default residual category. So if you don't want ACM, if you don't want fair value through other comprehensive income, then what you need is the fair value through P&L. Now, please remember, under amortized cost method, you recognize interest income. This goes to P&L. Under fair value through other comprehensive income, you do fair valuation. Gain, loss is taken to OCI, and interest income again to P&L. Okay. FVTPL, you do fair value, gain or loss to P&L. In FVTPL, there is no interest income. And please remember, FVTPL, you generally use it for equity investments, right? So these are the three ways of subsequent measurement of financial asset. Okay. Any doubt in these three methods? So Bala, you had a specific request for financial assets. So is there anything else you want me to cover in financial asset?
This is enough, sir. Like this is like a revision for me again, sir. Okay, sir.
Right. So that is for financial asset. For type of questions can be, okay, there is a debt instrument, then effective rate of interest is so much. What is the closing balance of financial asset, or how much of interest income will be recognized? Those aspects would be, covered there, right? Now, moving on to the next part, which is financial liability. So financial asset is just the opposite or ulta of your financial asset. Here you will follow amortized cost method or fair value through P&L. Under amortized cost method also, again, you will have opening balance, interest, interest paid, and closing balance. Under fair value, you will use the fair value method to determine the fair value, gain or loss to be taken to P&L, right? And initially, when you will recognize again using fair value, adjusted for the transaction cost, and subsequently you will measure it using ACM or fair value through P&L. Another important part of financial instrument when we look at it is something called as compound financial instrument. Now, what is this compound financial instrument? Say, for example, there are convertible debentures. Okay, face value 100, coupon 5%, tenure 3 years, and option to convert to equity at end of the. So one, 2, 3 years, you're at 0. Year 1, you will get 5% of 100. So 5 of interest would be paid. Year 2, 5 of interest would be paid. Year 3, 5 of interest would be paid. And then 100 of principal can be paid, or you convert this to equity. Let us say 10 equity shares. You take $100 or take 10 equity shares. So here, if you see, you have interest outflow. So there is an obligation to pay cash. There is a financial liability. At the end of the tenure also, there is an obligation to pay cash, financial liability, or to deliver equity. This becomes equity. So when there is a financial instrument which has both equity and a liability component together, that is called compound instrument. Now, the thing that we need to do here is we have to separate the liability and equity and account for them separately. So what I'm trying to tell you here is 1, 2, 3 years. Cash flow 5, 5, 105. Now this is optional, whether there will be a cash flow or there will be an equity issue. Okay. So you have cash flow of 5, 5, and 105. And there is an option to convert into equity. Now, please remember, when I say fair value of liability, this fair value of liability is present value of cash flows discounted at market rate of interest. So what we need to check is, assume for a moment there is this 5, 5, and 105 of cash flow. For this type of cash flow, what is the rate of interest in the market? What is the rate of interest in the market? Forget the conversion option. For this cash flow, currently, if there is no conversion option, what is the market rate of interest? Let us say market rate of interest is 10%. So if I just borrow money or if I just invest money, I will get 10%. So what we need to do is we need to discount this 5, 5, and 105 using 10%. 5, 5, and 105 using 10% and arrive at the present value. So 1 divided by 1.1. 1 divided by 1.1, you get 0.909. 0.909 divided by 1.1, you get 0.826. Divided by 1.1, we get 0.751. So cash flow multiplied by present value, you get 5 multiplied by 0.909, 4.54. 5 multiplied by 0.826, you get 4.13. 105 multiplied by 0.751, you get 78.85. Okay. So when you total it, this plus 4.54 plus 4.13, what you get is 87.52. You get 87.52. This present value of 87.52, this number is the fair value of liability. Now, total amount paid, 105. Fair value of liability, 87.52. The balance represents equity, which is 105 minus 87.52, which is 17.48. Okay. This represents equity. Please remember, we are accounting this in the books of the issuer. We are not accounting this in the books of the investor. For the investor, it is an asset. So here what I am assuming is, this is issued at 105. If it is issued at 105, the total amount received is 105. The liability is 87.52. Balance is equity. So the entry would be debit bank 105, credit financial liability 87.52, credit equity 17.4. Now this is change. What will happen to 87.52? Every year you will say opening balance 87.52, interest at 10%, so let us say 8.75, payout at 5, because 5 is what is being paid out. Then you have closing balance 87.52 plus 8.75 minus 5. Closing balance becomes 91.27. Like this, when you calculate, this is year 1, this is year 2, this is year 3. In year 3, this becomes 100. Now, if it is redeemed, if the investor says, I want my money back, you will pay 100. If the investor says, I don't want my money back, give me shares, this 100 plus 17.48 will be transferred to equity. Such advanced calculations are not needed, just for your understanding purpose. Okay. So, whenever there is a compound instrument, which is a convertible debenture, for example, you have to calculate two things. One, present value of principal plus interest at market rate. This gives us the financial liability. Then 2, total amount minus financial liability. This will give us equity. Very simple calculations. Students get unnecessary scared in this type of question. It's a very simple and a structured calculation that will help you understand, what is the part to be taken as liability and what is the part to be taken as equity. Any questions?
Can you hear me?
Yeah. Yes.
Sir, the sums alone will work out today, sir, and if we have any tools, we'll reduce. This chapter.
Yes. Please work out the sums. From the practice kit, the sections are given at the beginning of the the file, and using that, if you do it, it would be more than sufficient. Now we'll move to the next topic, which is IFRS 16. This deals with leases. Nothing much has been tested so far, so can expect a couple of questions, if at all they test in the examination. Right now, as far as IFRS 16 leases is concerned, leases is concerned with there being a right of using an asset. So we are accounting for this particular right of use as a separate asset. So there can be building. Building has been leased. So there is a right of using that building which is conferred on the lessee. So there are two parties, lessor, lessee, and there is a subject matter which is an asset. Let us say building. The lessor owns the building legally. Okay, so if you look at the title and all, lessor owns the building. Who uses? Lessee uses. Lessee has right to use the building for the lease period. And for that, the lessee gives something to the lessor, which is called lease payments, or you can call it consideration. The rentals and the variable payments and all of that. So there is a lessor who owns an asset. The lessor says, I am giving the right to use this asset to the lessee. Now, very important to understand, when we say there is a right to use, this right to use means have a right to direct how and for what purpose the asset is used. So if I have taken an asset on rent and if I want to apply IFRS 16 and say, okay, this is a lease accounting, then please remember, I must have the right to control, I must have the right to direct the use of that asset. Okay. Now, as far as the accounting is concerned, we have lessee accounting, which is the more complicated part. In lessee accounting, there is no distinction between operating and finance lease. So there is no distinction whatsoever between an operating and finance lease. Both the leases are accounted for using the same method. Both the leases are accounted for using the same method. So there is no distinction between operating and finance lease, right? That is one. Then when we say accounting of lessee, here we follow the concept of substance over form. Okay, we follow the concept of substance over form. Now, when the lessee does the accounting, lessee says, I have a right to use the asset. I have a right to use the asset, or I have a right of using that asset. So, when there is a lease and the lessee, the one who is using the asset, accounts for it as per IFRS 16. So, what the lessee does is the lessee creates or recognizes something called as right of use asset and lease liability. So the recognition by the lessee includes creating a right of use asset. We get a right to use the asset and lease liability. There is a lease liability. Lease liability is nothing but the liability to make these payments. There are more components included, but broadly, when I take asset on lease, say for example, I've taken this computer on lease. If I've taken this computer on lease, I say I have a right to use this asset. So I will recognize that asset in my books and I'll say there is a lease liability. Now, what is this right of use asset? Right of use asset is nothing but your lease liability plus initial direct cost. Lease liability plus initial direct cost plus present value of dismantling expense plus advance lease payments minus lease incentives. So when the lessee accounts for right of use asset, the lessee says the right of use asset is equal to lease liability. Now, what is this lease liability? This lease liability is what is calculated here? Present value of lease payments which are fixed. Present value of lease payments which are fixed. Then residual value guarantee. Residual value guarantee. Then, if at all there is an option to purchase, include that. If you are likely to exercise the option, then penalty. If at all the lessee believes that the lessee will terminate the lease and penalty would be payable. So, but for the examination purpose, largely you should focus on lease payments and residual value guarantee. In some cases, option to purchase. So what you do is you calculate the present value of all of these. The lessee is saying, listen very carefully, the lessee is saying, I as a lessee have to pay monthly fixed payments include. So that is included in lease payment. Then at the end of the lease, I have guaranteed some amount to the lessor include. At the end of the lease, there is a purchase option which I am likely to exercise include. Include all of these, calculate the present value which you get, that will be the lease liability. So you're saying today the lessee has taken or the lessee has a lease liability of so and so amount. Okay. Now this calculation, lease liability plus initial direct cost, some cost of entering into the contract, legal fees and all of that, plus present value of dismantling. After the expiry of the lease, if it has to be dismantled, that part include. This is in line with what we learned in IAS 16. Then lease payments, if I've already made the payments, that also will include. And if any lease incentives has been given by the lessor, that I will reduce. Now, please remember this present value of lease payment, this portion will not include this advance lease payment. So when I'm saying present value of lease payments here, this is only the remaining lease payment. Whatever is left over, calculate the present value of that. That plus present value of residual value guarantee plus option to purchase plus penalty, that gives me lease liability. Then lease liability plus initial direct cost, dismantling, advance lease payment minus lease incentive gives me right of use asset. So the lessee will recognize right of use asset and lease liability. This is the breakup. Now, how do we calculate this present value? You will use interest rate implicit in lease. You will use interest rate implicit in lease. If that is not available, see, because this is from lessor point of view. What is the lessor likely to earn from this lease? So that is the interest rate implicit in the lease. If that is not available, then you will use incremental borrowing. Okay, then you'll use the incremental borrowing rate. Right. Now, what we'll do is we will take a simple example here because this becomes very complicated if you are just trying to learn this or understand this. So we'll take one simple example. What I'll do is I'll use an Excel so that it is easy for me to calculate also. So this is the one which we will take up so that we can understand what it means. On 1st of January of 15, Plum entered into a 5-year lease of machinery. The term is 5. Lease term is 5 years. The machinery has a useful life of 6 years. Lease term is 5 years. Useful life of 6 years. Annual lease payments are 5,000 per annum, with the first payment being made on 1st of January. So payments are 5. So if you look at the payments, very important to understand the dates also. 15, 16, 17, 18, 19. So 1, 2, 3, 4, 5. 20 will be the 5th year, right? 15 to 16, 17, 18. Sorry. This is which date? January. So again, I'm drawing it. So if you look at a timeline, You have 2015, 16, 17, 18, and 19. Okay. So first year, second year, third year, fourth year, fifth year. Payments are happening at the beginning of the period. Payments are happening at the beginning of the period. To obtain the lease, Plum incurs initial direct cost of 1,000 and the lessor agrees to reimburse 500 towards the cost of the lease. So 500 reimbursement that the lessor is giving is lease incentive. The rate implicit in the lease is 5%. Present value of the minimum lease payment is 22730. So they themselves have given present value of minimum lease payment or the present value of lease payment is 22730. Okay, so now here if you see here 1, 2, 3, 4, 5 lease payments 5,000, 5,000, 5,000, 5,000, 5,000. Each one of this is paid at the beginning of the period. Okay. Now we need to calculate present value. Please remember present value of lease payments which are left or which are yet to be paid. Now, two ways it is possible. One, you can say this is already paid. I will take it separately. That is one way to calculate. Or second, you can say after entering into the lease, we are making the payment on the first day. So the present value factor will be 1 because the interest rate implicit in the lease is 5%. First payment will have a present value of 1 because I'm paying today. Then second payment is paid after 1 year. So present value factor is 1 divided by 1.05. Then this divided by 1.05. Then fourth, then fifth. So these are the payments. Okay. And present value if you do 5,000 multiplied by 1. 5,000, 4761, 4535, 4319, and 4113. Basically, multiplication of all of this. So if you do a sum of all of this, what you get is 22729. And that is what is given here. The present value of the minimum lease payment is 2273. Now, 22739 is the present value of lease payment. What the entity has to do is ROU asset is, so this is called lease liability. So ROU asset is lease liability. So what is the lease liability? 22730. Then initial direct cost. Initial direct cost is 1,000. Then lease incentive 500. So ROU asset is 23239. So what happens is debit ROU asset 23229, debit bank 500. So why debit bank? Because this lease incentive is received. Credit bank 1,000 initial direct cost paid, and credit lease liability which is 22729. Okay, this is how you will initially recognize. Then subsequently what happens is you prepare a lease amortization schedule. Now in the lease amortization schedule, you take year, opening balance. Now when lease payments are made in advance, you first take the payments, then balance for interest, then closing. So year 1, 2, 3, 4, 5. Opening balance of lease liability is 22729. Payment is 5,000. Balance for interest 22729 minus 5,000. Interest at 5%, 17729 into 5%. Closing balance. Balance plus interest 18616. Then opening balance 18616. Payment, interest, closing balance. So like this, you prepare schedule for the next remaining 5 years. You will get the value. So what happens is every year you pay 5,000. Out of that, first 5,000 payment does not include any interest. The second 5,000 payments include interest of 680. So what happens is every year you will debit finance cost, credit lease liability. So finance cost 886 first year. This is what you will record. Then when you make the payment, you will say debit lease liability 5,000, credit bank 5,000. So like this, every year you pass the entries and you reach the you make the lease liability 0. And this right of use asset will be amortized over 5 years. Now, why only 5 years and why not 6 years? Because we are using it only for 5 years. So we amortize the asset over a 5-year period. Okay, any doubt there? Now, few things that you have to keep in mind when we talk about lease payment is variable lease payment. This will not be considered in calculating present value of lease payment. So variable payments like performance-based payment, payment based on, let us say, sales, payments based on production, payment. Let's say we say, okay, there is a mall, there is a shop in a mall. 5% of sales has to be paid by the lessee to the lessor. If such kind of arrangements are there, those are not included in this lease payment. Here you include only fixed lease payment or in substance fixed lease payment. Variable lease payments are not considered in this particular part. Then what do we do with this variable lease payment? We will recognize it in P&L as and when the amount is paid. So whenever the amount is paid, that part will be taken to P&L, right? So to quickly summarize, lease liability is the present value of lease payments plus the residual value guarantee plus the purchase option. ROU asset is lease liability. Here for you to see, lease liability plus IDC plus present value of dismantling plus advance lease payment plus minus lease incentive, right? So that is what you will recognize as a part of lease accounting for lessee and the ROU asset and the lease back. Then we have another concept called sale and lease back. For example, let us say there is one company which is Reliance. Then there is another company, let us say British Petroleum. Okay, you have Reliance, you have British Petroleum. Reliance has a refinery. What Reliance does is, Reliance sells this refinery to British Petroleum. And under the same arrangement, British Petroleum leases the asset back to Reliance. So Reliance sells the refinery to BP, that is British Petroleum, and British Petroleum leases back the same refinery back to Reliance, right? Now, this is a transaction where there is a sale and there is a lease back. There is a sale, there is a lease back. Now, what we need to understand is, whenever there is an integrated transaction of sale and lease back, first question that you need to ask is this sale or does this sale transfer the control of the asset? Is there actually a sale happening? If sale is happening as per IFRS 15, is there a sale as per IFRS 15? Then you will recognize the transaction as a sale and you will recognize you will account for the lease back transaction as per IFRS 16. So if there is a sale transaction and a lease back transaction, the sale transaction meets the criteria of sale as per IFRS 15, then you will recognize the sale and you will recognize the lease back separately. But if sale criteria not met, so now what is the case in which sale criteria is not met? A very simple example. Reliance sold the refinery. The refinery has a useful life of 15 years. Reliance again took it back on lease for 15 years. Reliance again took it back on lease for 15 years. So if Reliance has taken it back again on lease at 15 years, the asset has not been transferred. In substance, the asset remains with Reliance. So in that case, what you need to do is, the seller or now the lessee will continue to recognize the asset. See, when the sale criteria is met, the asset is de-recognized. When the sale criteria is not met, the asset is not de-recognized. You will continue to recognize the asset. Sir, then what about the amount received from British Petroleum? Because refinery is sold to British Petroleum. British Petroleum paid the money. Amount has been received. So the amount that is received is considered as a financial liability. So this means the amount that is received is considered to be a financing given by British Petroleum to the lessee, or to the lessee or to the seller. Then what in the case of buyer? What the buyer will do is buyer will not recognize asset, but buyer will recognize financial asset as loan given. Now, how will this liability and loan be settled? See, when this British Petroleum leases this to Reliance will make payment of lease rentals. So using that lease rentals, you will settle the loan liability and the loan asset. Now, if the sale criteria is met,
it's 13 hours.
So what is happening? See, this is an asset. Asset is sold. And let's say this asset has a useful life of 10 years. And this is the buyer. And this asset again comes back for, let us say, 6 years lease. So in effect, I have only transferred 4 years worth of asset to the buyer, because for 6 years, I will only be using. I have sold the asset, I have taken it back on lease. For the another 6 years, I will only be using. So the entire asset has not been transferred. So whenever the sale criteria is met, I have transferred the control of the asset, but I'm again getting back the control for some specified period of time. Then in that case, how should the accounting be done? Right? Then in that case, how should the accounting be done? For buyer, it is very simple. Whatever asset he has purchased, we will account for it as purchase of asset, and whatever is the lease back that he is doing, he will account for as per the lease accounting for SR. Whereas in case of the seller lessee, what the seller lessee has to do is, because I have sold the asset, I will de-recognize the asset. I will de-recognize the asset. Okay, I will de-recognize the asset and I will account for sale at fair value. I will account for sale at fair value. There is a sale part. Now there is a lease part also. So I will calculate lease liability, which is nothing but the present value of lease rental. That is the present value of lease rental. So lease liability will be recognized. I will also recognize a right of use asset, because now I am recognizing a right of use asset. So see, this asset I am de-recognizing, and this right of use asset I am recognizing. I am recognizing the right of use asset. Then, because I am retaining some right and I am de-recognizing the full asset, but I am again recognizing part of the asset, the gain or loss should be recognized based on asset proportion transfer. So the gain on entire asset is not recognized. You will recognize the gain only to the extent of the proportion of the previous asset which is actually eventually being transferred. Because I am again recognizing a right of use asset afresh. What is the proportion of this right of use asset on the original carrying amount? Right, only to that extent I cannot recognize. Only for the balance portion I will recognize. Such advanced level questions are not expected to be tested, because not like a revaluation gain. Okay, let us not mix two different concepts. It is more like I have not transferred the entire part of the asset because I am retaining some component. So that is where gain or loss should be recognized based on the proportion. So what I'll do is, in tomorrow's session, in the next session, I'll take up an example and I'll further elaborate on how this part is to be handled. Okay. So we'll conclude here. We have covered two broad, very important standards. Tomorrow, after completing leases, we will move on to revenue accounting. That is another important aspect. Then we will, move on to other standards. Okay. Any question? And I am on purpose. It is fast because it is a revision. Okay, so I cannot go slow. I have to power pack all the concepts and tell you, okay, these are the important things that you need to remember for the examination. Thank you.